You've probably heard of this term RMDs, which stands for Required Minimum Distributions. And if you're not exactly sure what they are or how they work, don't feel bad. They're just part of an already confusing tax code. However, they are a very important part to understand because it's a big part of retirement tax planning, and it can lead to a 50% penalty if not done right. In this video, I'll explain exactly what you need to know about required minimum distributions and how they play into helping your money last longer. Welcome to another video. I'm Dan Lohmar. I'm a CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you watching, my business partner Alan Bewley and I are both pilots for United. Required minimum distributions are a big part of retirement tax planning. They cause unnecessary taxes and in some ways make us lose control of how we generate retirement income. And if you don't take these right, it could result in one of the biggest penalties in the tax code, a 50% penalty imposed on untaken RMDs, plus the taxes. So let's just go to the computer and talk about this very important part of helping your money last longer.
All right, so let's talk about required minimum distributions, aka RMDs. You've probably heard about them. There's a few more details to them than what you might think. So let's get into that. This is good stuff to know. I'm going to talk about the high points. There's so much of the tax code revolving anything with taxes and your personal situations. There's no way I can cover everything. So we're going to talk about concepts. And really when it comes to a lot of this stuff, I always say consult your tax advisor for your particular situation. So why do we have these things called required minimum distributions or RMDs? And just essentially what happens is the government allows us to defer taxes on certain types of accounts up until age 70 and a half. And at that point, they say, all right, you've deferred taxes long enough. We want to start getting our hands on your money. And so we're going to make you take out a certain amount each year, starting at age 70 and a half for the rest of your life. And that's what's called a required minimum distribution. It's the minimum amount you need to take out of tax-deferred accounts. Which types of accounts do they apply to? Tax-deferred accounts and Roth 401ks. Technically, a Roth 401k is a tax-free account, but the money still comes out tax-free, but they do make you take a certain amount out of a Roth 401k. But the types of accounts are usually traditional IRAs, 401ks, Roth 401ks, qualified annuities, and other accounts like 403bs, 457s. The biggest thing I'll be talking about today are traditional IRAs and 401ks like the PRAP. What's the issue? If you're living off of the minimum amount or more, it's really not an issue because you're taking that amount out anyway for living expenses. But let's just say that the RMD is a lot more or any bit more than what you need for living expenses. The issue is you got to pay taxes on it. It ends the tax deferred status of that money. It can push you into a higher tax bracket, and it can cross the Medicare IRMA threshold and increase your Medicare premium. So that's why it's an issue, and that's why it's good to try to minimize RMDs if you can. We'll talk about that. How much is an RMD? So what is the minimum amount that needs to come out? Well, it depends on your account balances, and it depends on your age, which dictates your life expectancy. So essentially what you do is you add up all your account balances, you divide it by your life expectancy, and that number is your required minimum distribution. On these links right here, these are two forms that the IRS has to help you calculate what the RMD is. And I have these links in the video description on YouTube. So if you want to see those forms for yourself and download them, just click on those links. This is what they look like. That's the normal one. As you can see here, you look at your age, you look at your distribution period, and you divide by your account balances by that, and that's how you come up with your RMDs. But they walk you through it on this thing. This one's slightly different. If you have a beneficiary, a sole beneficiary of an account that is, and that sole beneficiary is 10 years younger than you, then it's a slightly different calculation. So they provide this form for that. Rules for IRAs and 401ks are a little bit different. So you can total up all of your IRA account balances as of December 31st before the year that it's due. You add all those up, and you can take your RMD out of one IRA, or you can take it out of any multiple IRAs if you have more than one. So you can take it out of one, or you can take a little bit out of each one. 401ks are a little bit different, and that is that 401ks have to be calculated separately. You have to take that amount out of that 401k. So that's just something to know about IRAs and 401ks. What is the age 70 and a half rule? Well, RMDs begin in the year that you turn 70 and a half. So that is the year that your first RMD needs to be calculated for. The first distribution, this is where it gets a little confusing. The first distribution is not due until April 1st after the year that you turn 70 and a half. But the problem with that is if you delay that first distribution until that year, you have 2 RMDs due that year. So just because you waited till April 1st to take it out, your first one, doesn't mean that complies with that year also. You actually have to take it out for that year too. So you could potentially have 2 RMDs in that year, and that could potentially put you into a really high tax bracket and cross multiple IRMA thresholds, the Medicare thresholds, just depending on how much you're taking out. So just a real quick example, Captain Joe here, he turned 70 in September of 2019. That means he turned 70 and a half of 2020. So his RMDs actually begin in 2020. But he's not required to take the first one out until April 1st, until before April 1st, 2021. But he still has an RMD due in 2021 for that particular year. So if he waited till 2021 to take that first one out, he has 2 to take out. So what I say on this stuff is it can kind of be confusing with this 70 and a half rule and when you take it out. Don't worry about the math too much. When the time comes for you, just do it for yourself and talk to your advisor about when your RMDs are due. What about Roth IRAs? Roth IRAs do not have required minimum distributions. So money stays in a Roth IRA account, it continues to go tax-free, and it comes out tax-free. So that's a really, really beneficial thing about Roth IRAs, especially when it comes to long-term tax planning. And I talk about in some other videos these things we do called Roth conversions. That doesn't apply just while you're working. Is sometimes you got the best opportunities to do those in your early retirement years. So that's a big factor, is potentially doing Roth conversions to get some tax-free money in there. What about Roth 401ks? Slightly different. Roth 401ks do have required minimum distributions. So at 70 and a half, they do make you take out a certain amount out of a Roth 401k. And our PRAP does have a Roth portion in it. So the money still comes out tax-free. It's just that they make you take a certain amount out of the Roth portion of that. A workaround to this is that you can consider rolling a Roth 401k into a Roth IRA. And then that way you comply with the Roth IRA rules. You do not have a RMD in the Roth IRA at that point. The thing you got to be careful about is that Roth IRAs and Roth 401ks have this thing called a 5-year rule, where money needs to be in that account for at least 5 years before you can take a qualifying distribution. And if you roll a Roth 401k into a Roth IRA, and there's no money in that Roth IRA already, it starts at 5-year rule over again. Something to be aware of. That's about all I'm going to say about it. The 5-year rule, just know it exists and talk to your advisor whether you're subject to the 5-year rule or not. So a couple questions. What if I'm already withdrawing at least as much for living expenses? I already talked about that. Hey, you're already meeting the minimum amount that's coming out, so you don't need to pull any more out. What can you do with the money? Obviously, live off of it. You can save it for future spending, or you can reinvest it in a taxable account. Can you roll an RMD into a Roth IRA? And the answer is no. But after the RMD is taken out, you can take remaining balance and roll that into a Roth IRA. It's a taxable event, but you can do that with what remains in there after the RMD. The distribution deadline every year is December 31st, the year that they're due. And of course, the first one isn't due until April 1st after the year turns 70 and a half. But again, this would result in 2 RMDs for that particular year. What if you don't take the RMD by December 31st? Ooh, it's a big penalty, 50% penalty on the amount that didn't come out. And you still have to take the withdrawal. You still have to pay taxes on it. So this is definitely something that could be a big factor. What if you have a good reason for missing the RMD? You can file a letter of explanation with your tax return, must be approved by the IRS, and you still have to take the RMD. But sometimes this does happen. In one case, an elderly lady was in the hospital the entire month of December. She missed it. It was a good reason. It was legitimate, but the IRS still had to prove the reason for it. So anyway, there is a way around it if it's a legitimate reason. Let's do a simple IRA RMD calculation. Joe has two IRAs, one for $100,000, one for $75,000. He's age 72. His life expectancy is 25.6. He divides about total by 25.6, and his RMD is $6,835. And that's for both. That's for either one of those accounts. That amount can come out of one account, both accounts, or a combination of either one. So let's just, now he has to do it separately for a 401k or his PRAP. So yeah, 2.5 million, age 72, he divides that by 25.6, and his RMD for his PRAP is 97,656. And it must come out of that particular 401k. So as you can see, you add them both up, he's $104,000, almost $105,000. That's required to come out of a combination of both of those accounts. And let's look at a situation just as an example. Here's a hypothetical. Captain Joe and Jane, they're 72. What they desire for living expenses and what they're planning on for the rest of their life is right around withdrawing $168,000 of gross income. That's right at the top of the 22% tax bracket, and it's right below the next higher IRMA threshold of $170,000 to keep their Medicare premiums lower. So that's what they're planning on. He does the distribution with his taxable portion of Social Security. They both have Social Security. His PBGC is $40,000, and their RMDs. You add all that up, and it's an adjusted gross income of $208,000. That's $40,000 more than what he needs or what is desired. So this is a situation where required minimum distributions put you into a higher tax bracket, and they put you into a higher IRMA threshold. So here's taxes are a lot more than what he wants to pay or needs to pay, but then. And then also he pays close to $1,300 extra in Medicare Part B premiums for the year also. Could they have done anything? Yes, they could have done a number of things, but the biggest thing would have been planning ahead for it for sure. This is where in the early years of retirement, and I talked about the stages of retirement back in my second video, this is where looking ahead really can play out. But in the current year, the thing that they could have done is taken a qualified charitable distribution, and what that is that they're charitably inclined and they want to give money to charity. They can transfer money directly from a tax-deferred account like an IRA. They can transfer it directly to the charity. That counts as the required minimum distribution or towards it anyway. So that helps. And it's not the same as receiving the money and writing a check for a charitable donation. That's a below the line deduction, and that would have not helped in this situation. So a QCD would have helped them out. That's something to keep in mind. As they were planning early in the early stages of retirement, that what could they have done? They could have delayed Social Security and PBGC because they would have been living off these taxable accounts earlier on. They would have been drawing down on the balance, which lowers their RMDs. So that's also a possibility. They could have done Roth conversions in their earlier years. And what that is if you have taxable money and taxable accounts, and what I mean by taxable accounts are those are the accounts you've already paid taxes on. So like say you've got cash built up, you can live off that for a couple of years. That creates a very, very, very low tax bracket, and those are very good years to do Roth conversions. So you're pulling money from these tax deferred accounts. You're paying taxes on it, but you're in a lower tax bracket. So you pay lower taxes. It also lowers the balances in the accounts, and so it lowers your RMDs potentially. So those are some things to think about, and this whole video series covers a little bit of each one of these on different videos, and that's exactly what my next video is about, is tax efficient withdrawals, which leads to this one. So tax efficient withdrawals, that's essentially what we're talking about. That's what my next video is about. And what that has to do is the order in which you withdraw money from different types of accounts, taxable, tax deferred, tax-free accounts. The order in which you withdraw makes a huge difference on your lifetime tax bill, and that's what that is about. So when I put that video out there, go ahead and subscribe actually, and hit the bell icon. That way you'll know when the next video comes out.
So those are some highlights that you need to know about required minimum distributions, and it's certainly not everything. There is a lot more than this, so be sure to consult your tax professional about the rules that apply to you. But it sets the stage for my next video about tax-efficient withdrawals, and that's how to withdraw your money from various types of accounts in order to pay fewer taxes over your lifetime and help your money last longer. And a big part of that is managing the RMDs I just talked about. And so that you know when that video comes out, go ahead and subscribe and hit the bell icon so that you get notified. I'm Dan Lohmar, CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley and I are both pilots for United. Until next time, stay the course and invest with a plan based on science and evidence. Everything else is just guessing.